threatening, which I can officially now tell you after I've watched him yesterday doing a similar event, that he's one of the most knowledgeable people in the industry. He perhaps will tell you a little bit about his day job, which is very interesting, but he's really, I think, the most proficient person in capturing what is new and exciting in the world of venture because of his unique position and the job that he's doing. We have about an hour for this. I want to say something that connects to what I said earlier about research. Next year, one of our research strands is going to be new financial models. New financial models is what are the models in which we finance these innovations. You know, we have a VC, that's one model. Maybe we have crowdfunding, that's another model. We have a loan, we saw some of the policy stuff. We are looking for some creative things. Hopefully in a year from now, we will have a whole booklet just like this on the history of venture that will deal with financial models. That's the reason this panel and this section is very important. After that, of course, we will have a lot of time for discussion. And I do remind you that each of you have a free copy of this at the other room.
Thank you. Well, good afternoon, everyone. It's nice to be here, and thank you for the kind introduction. I've got Tim Lafferty and Jeff Chi, who's with me on my panel, and they'll introduce their companies and their day jobs and non-day jobs, if they'd like. There will be some slides. Normally I don't do slides. Normally I just kind of talk, as Ellie well knows. Now I was told I was going to be presenting to 200 young brains. I was presenting to 200 young minds, anywhere from the age of 18 to 80, who are going to come here and change the world. So where did the other 180 go? But the minds are all sparky, and given that the time of day it is, it's 4 o'clock. Is that you? Should I take it? Okay. So anyway, all right. Venture, as you know, started off in the 70s in the United States. Where did it start, folks? Where did it start, venture in the United States?
East Coast.
Oh, you can't say anything. Boston. How many of you knew that? Did you raise your hand?
We just had to talk about the history of venture. So.
Yeah. Oh, you did, you cheaters. You complete cheaters.
Ellie stole your thunder.
Now, what brought it to the West Coast besides the genius of Stanford? What was the nuance that Stanford offered?
Sunshine.
That's one thing. Boston also got nice sunshine in the month of August. Free agricultural land that was being turned into a workspace. And so they made a deal with the state of California, and they made a deal with the local government to be able to incubate and create the companies that were then put in place. So you want to kick in my slides? Okay. All right. So we're looking at first slide? Yeah. Okay. Now, what drives venture? And venture is driven by the edge of technology. It's driven by those whose minds will go where others haven't, and it's driven by the needs of the population. So the question is, where after World War II, a huge amount of scientific knowledge went into the United States because you had very intelligent academic institutions that were able to bring them over and offer very good positions, like NYU, for example, offered a whole series of engineers jobs and homes, and so they all moved over. So you had this in very fertile environment, in a homogeneous type environment, where you had a real change in the people. Now, that change, as of 2012, whether it's GDP as a percentage of total growth, or the consumer, the user, is moving east. And the question is, how do you capture it? Consumer products are starting to figure this one out, because consumer products are all taking their brands from Europe and the United States and moving them east. But how do these minds work? How will these people work? But the statistics are overwhelming when you think that the middle class by 2020 in Asia will equal the total population of Europe. And they all will be driven by the modern world. You got to remember, when Central Europe changed from its political regime, banking never had a checkbook. They went straight into electronic banking. There was never a checkbook. So how will things change? And for those minds and academics that believe that there's some linearity or duplicity, that's not going to be the case whatsoever. And if you ask the US government, some of the brightest minds are in China, who they keep trying to work with to stop coming into the US information systems, correct? So the minds are there, the talent is there, but the use of it will be absolutely fascinating. And so the question is, will science drive or will the consumer drive? Will we look for making returns, or will we looking to create the edge of technology? Will we change science? To change science, you need government backing. You need full-fledged policies. Europe failed. They created the European Investment Fund, who is the main source of all funding for Europe. Venture. And it struggles. Because after you get the EIF, it's very hard to get more people into it. And so when you go into the United States, they were fortunate because in the 70s, they were able to get the endowments and the foundations involved. And through the academic institutions and their funding bases, were able to build a fantastic environment which stimulated both a consumer-led technology as well as a scientific technology. Now, U.S. venture capital just dominates statistically. The question is, can it change? And the issue here is it's been around such a long time that it has a huge amount of positioning. But if you look at the essence of venture capital financing, if you look at the essence of angels and seed and startups, you can't scale venture capital. What is scalable is to come up with an idea, package the idea, turn it into a corporate, develop the corporate, grow it, list it, and then somebody buys it as a buyout. The very first transaction in Asia apparently is around the corner that will have done that cycle, which is interesting. The largest deals in Asia, these are some of them. As you can see, they cut across different sectors where there seems a lot of activity is taken through the internet. Now, one of the things that is fascinating, this morning I went to a consumer product specialist who specializes in products in China. And the biggest area of focus for food products and food product distribution, snacks, was internet sales. I don't buy my potato chips on the web, right? I don't quite associate. I can't understand this, but this has doubled the profitability of a particular company, right? Now, my children, who are 25 and 23, my daughter is in publications. She has her magazine, and my son's in media. They sit there and they want to eat something. They need a document. They need a little pointer. And they go to these apps and they click, and then some random person walks in and hands them the stuff. I can't relate to this, right? Now, my best friend from childhood, who's my age, 57, creates the software. I used to write software because my computers used to be as big as this room. And the only way to communicate was to write software, right? But the applications of this is amazing. Now the question is, how many of these companies will be with us in 5 years, 10 years, 15 years? If you take the Fortune 500 in the United States and you look at every 10 years, they're very different companies. Very different companies. So will this kind of follow, and how will this work in? Will be very interesting. Performance. Performance is everything. Now, while performance of the mature venture capital has strengthened, overall, It, it varies a little bit. Now, the U.S. performance is very steady and very long, and you can kind of see how it works over a period of time when you look at these types of numbers, and you look at how that outperforms everything. But in the short term, venture does not have this type of benefit. And if you compare it to other classes, sometimes, and this is the best groups that you can look at, it can be lacking. And that was part of the problem with the European venture. And European venture was not profitable, except for one or two individuals that were able to drive certain opportunities or to identify them. Now, Asia is still extremely nascent. And within this, one of the things that we need to be very careful about when we look at a venture, again, it goes back to the essence of the science or the kind of corporate element that we're trying to kind of be the end product of the creation of venture or of venture products, is where do we want to take these? And, if your objective is to list a company, chances are very high you're going to not perform. And so back in the early 2000s, when some companies, like for example in Europe in life science, were doing incredibly well, one of the things that they needed to do, because they could not find funding, they listed themselves. And they basically locked in whatever return profile they had at that point. Because the listing, because of the volatility of the market, because of the illiquidity of the particular companies, were not able to get anywhere. So to the extent one can avoid listing as late as possible, it's extremely important. And so the question is, where do you get the capital from to be able to grow the companies? And the trick is the science versus the profitability. And so all those that are in the room that are creators have to leave the room because you're not business people. And you have to give control away. And that's really hard to do. So now a good friend of mine, good friend of my son's, created something that put everybody together. It match-made them. And the young man is outstanding in his technology. He's outstanding in his understanding of marketing and messaging, but the business had to be run by somebody who runs the business. So he was given a couple $2 billion. Part of it's still in the company. He's still involved. Part of it is in his cash account. But now somebody is running this company and kind of really building it, right? But then the question is, at that point, that edge of the technology he's not there anymore. He's kind of going with that corporate flow, right? In a way, it's almost would be more neat to release him to go create another company, even if it is a competition, because he's a mind, and keep feeding him cash and let him become whatever he'd like to become, and help him change the world, as opposed to kind of cocooning him. So he's at that crossroad right now. Now, interestingly enough, where's the next hub? What areas are interesting? In today's world, it can be anywhere, to be very honest. And what drives people sometimes is governments that offer initiatives and offer think tanks and areas of opportunity like we have here. And in other cases, it's the young people. In San Francisco, the rental prices have gone up 10 times. They're still cheaper than New York. So New York has nobody that's at the cutting edge of creation. They're still on the West Coast. But guess what, folks? They're moving to Portland, Oregon. Because Portland, Oregon, the rents are 1/5 what they are in San Francisco. And, it's not a bad life either. So you move north, you move south, it doesn't matter anymore. But one thing I know, which is really interesting when talking to a venture investor, he doesn't look at numbers anymore. He doesn't look at reports anymore. He doesn't look at track records anymore. He just looks at the people. And he follows the people. So when I ask him, I say, where have you been? He goes, I was in Miami. Where have you been? I've been in Vegas. Where have you been? In New York. I was like, are the people from there? He said, no, the people are just hanging out. And so they've become a hangout crowd. Now, the investor appetite is definitely there. And this is one of the things that some of my panelists, distinguished panelists, will talk about. But you can see, if you're looking at kind of the bulk of the money, Yeshi mentioned I had a panel the other day. One of the panelists has $70 billion US in alternatives, of which 10 billion is in Asia and will probably triple in the next couple of years. Is any of that going to venture? It can't, because venture can't absorb that money. Right? But what it is going into, it's going into wealth creation, it's going into healthcare, it's going into growing other companies where individuals will then be consumers or users, or their children could be at the forefront of science. But it's indirect, you see. So the question then is, where can direct capital from? If you're looking at investors, they typically are quite intense, and that's why I'm going to hand over now and let Tim introduce himself. But one of the things that we wanted to try to look into is, how can we step away from this, and where is our future? So that's just, I want to set a little bit of a scene. I'll hand over to Tim. Tim, if you'd like to come up, and say a couple of words of the perspective you're coming from, and then we'll have a little bit of a chat. Thank you.
Good afternoon, everybody. Thank you to Yesh for inviting me to Hong Kong, especially because I used to live here back in the 1980s. I'm that old. I was serving here as an officer in the Royal Navy, and I was second in command of a patrol boat where we spent most of our time chasing smugglers and not really catching them very often. There was some innovation, actually. If we got some Royal Marines in a fast patrol boat with two big engines on the back that went about 60 knots. So the smugglers innovated and they got offshore power boats. So we got a helicopter, but we still couldn't catch them. So I'm Tim Lafferty, and I'm COO of Mawsonia. We're a little publishing company that cover three areas of venture capital, which are corporate, government, and university venturing. We started about 5 years ago. I worked for Dow Jones with my colleague James Mawson, and he was an editor and I was the head of sales and marketing for Europe for Dow Jones. And he identified that there wasn't a trade publication for corporate venturing, even though it was a growing area. There weren't really global events, there wasn't much data, there wasn't much sharing of best practice. So he started to write about it, and we had our first conference 5 years ago, so it was 5 years old this year, and we have like 400 people come to London, the top sort of people in corporate venturing, and Al Gore's spoken at it. So it's kind of taken off a bit. So we've almost become a bit more of an event company than a media company. 3 years ago, we launched Global University Venturing, which looks at how universities invest in spin-out companies. And then government venturing is how governments are increasingly creating funds to invest in startups. So that's a little story about how our company came about. So I'm going to briefly talk about those three areas of venture capital. So corporate venturing has taken a bit of a leap in the last year and a half or so. You can see the number of deals in 2014 was about 1,400, and it's going to surpass that in 2015 by the end of the year. In terms of dollars, it's already well ahead of last year, $64 billion. And part of the reason for that big jump actually is the transport sector. So Uber is in that sector, and the China equivalent of Didi Chuxing have raised quite a lot of money this year. So it's definitely a boom time for corporate venturing, which has kind of filled the gap a little bit for traditional VCs that some of them have fallen by the wayside after 2008. If you look at it geographically for corporate venturing, you can see the US is still a sort of 300-pound gorilla with 1,000 deals in the last 12 months. China's about a fifth of the size of that, but growing quite quickly, and it's sort of second biggest market. One of the things I think quite interesting about this chart is if you look at the US pie chart there, the red sector is IT, so that's the biggest sector, and then the second biggest is the green one, which is health. If you look at the China pie, the light blue sector is the biggest, and that's consumer, which kind of ties in with what Moose was talking about a little bit in terms of buying your snacks and so on. That would fall into consumer sector. IT is the second biggest, and then health actually is one of the smaller ones at the moment. These charts, by the way, quick plug to our just because we've just launched it, it's a new data analytics product called GCV Analytics. So we've tracked 5,000 corporate venturing deals over 5 years, and we've now got this tool where you can cut and dice the data in different ways and create pretty graphics. So if anyone wants a demo later, I'll be happy to show you. It might come in handy in tomorrow's sort of research discussion. Just to talk about, because the title of our panel was sort of models of venturing and LPs, just to touch briefly, I won't sort of go through this in too much detail, but how corporate venturing is sort of structured. There's sort of a continuum. At one end, you've got purely financial goals, and the other end, purely strategic goals. And most corporate venturers have some form of strategic goals, by which I mean they're looking at, they recognize that they're not very good at innovating generally, and that they need to work with entrepreneurs, and they need to understand where technology is going, because it might take them in new directions and help them to prosper. Or if they don't keep an eye on it, these new technologies might come and eat their lunch. So a little while ago, the hotel groups, Hilton and Intercontinental, they thought their competition was each other, and they were completely blindsided by Airbnb. So funnily enough, they've started doing corporate venturing now, and nobody wants to be the next Kodak or the next Blockbuster, right? So so there are some corporate venture capital groups that only have financial goals, but you could argue, well, are they really corporate venturing organizations? So, that if all they're doing is looking to make a financial return, then they're the same as a VC, really. So most have a mixture of financial and strategic goals. And Qualcomm, I quite like the way they describe it. They say that the priority for us is strategic, but we don't want to be a cost center either. So, because if you're a cost center, as soon as there's a bit of a downturn, you're likely to disappear. And something else we're seeing more and more of now is multi-corporate funds, where you have a GP managing the fund, and then corporates are LPs. They're the limited partners in the funds. Asta and Iris are two examples. So France actually has quite a lot of that going on at the moment. So some corporates are actually doing investments from their balance sheet, and that can be quite good in that you get buy-in from the top. Others are sort of separate funds, and they can be a bit more nimble because they're a bit more independent, but they don't want to get too far away from the mothership. Otherwise, one of the benefits of taking corporate money is that corporate hopefully can help a startup channel into its various resources, whether that's marketing resources or R&D, globally help them scale up. So they need to be close enough to be able to make the introductions to the business units. And then something else we see a bit of, particularly common in sort of new corporates new to venturing, is they might start off investing in VC funds as a way of kind of getting to understand venture capital. One thing that we're seeing the rise of, and we might want to talk about on the panel if people are interested, is the rise of the corporate accelerator. There's several hundred now corporate accelerators, or either run by corporates or backed by corporates. So there's probably discussion to be had: are corporates the right people to be running accelerators? What's working and what's not? So university venturing, I don't know if you can see this very well, it's a bit faint, but just to give you a kind of idea of the scale of it, last year there were over 500 deals totaling about $8.5 billion globally. Most of the activity is in the US, and the UK is not far behind. The health sector is the biggest, and the reason for that is that health, particularly sort of drug development things, really struggle to get shorter term venture money. So VC funds, typically 5-10 years, they're not interested in something that's going to take 20 years of development. So universities can step in and support that. The reason that universities do venturing is they want to be able to support their faculty and their students. It's good PR for them, and also they can make a financial return. So one example, there's a spin out from Dresden called Novaled, which initially got corporate venture financing from Samsung, and was then bought last year by Samsung for $345 million or something like that. So good return. No university wants to miss out on the next Google or Facebook if they can avoid it and make some sort of return. I won't go too much into the sort of different models, but some of them run their own funds, some of them outsource it. So Imperial in London is quite a good, successful one, and their venture fund, Imperial Innovations, actually is quite separate now from the university, and it's actually a listed company on the AIM stock market. And Imperial, the university itself, only owns about 20%. Probably can't read this very well, but you will get the slides afterwards if you want the detail. But this is a list. We attempt to sort of rank who the most successful corporate venturing units are, and if you can read it, you'll see that they're all in North America or the UK. There's a bit of blurb at the bottom which kind of includes a disclaimer that there may be data that's hard to come by from other universities, particularly China, for example. Tsinghua would probably be on this list if we could get the data. There's probably some Israeli universities that are not far off being on this list as well. Government venturing was covered really well by Robin earlier. Something that we look at. Governments basically recognise that to grow an economy, you have to support startups to go from being a small company to being a large company. You don't grow an economy by having a large company becoming a slightly larger company in general. So there's a lot of activity going on around the world. Some examples, Robin gave some good examples. In Germany, the largest VC is High-Tech Gründerfund, which is a state fund which has about 20 corporates as LPs. Singapore's doing a lot. We had a conference in Brazil 2 weeks ago. The Brazilian government, or part of it, called Apex, invited us to collaborate with them. They commissioned us to bring in 20 corporate venturers because they really want to attract inward investment and get those large corporates investing and doing their R&D in Brazil. The Eindhoven government did the same with us in February. We did a conference there. They wanted to raise the profile of a tech cluster, rather similar actually to Cyberport, but it's called Brainport. So again, we brought in international speakers. So there's a lot that governments are doing. And beyond what Robin was talking about in terms of specific stuff to do with venture and innovation that governments could do, I would say they also probably need to think about the larger environment, which is much harder thing to fix. But if you're trying to attract companies to come and locate and put their people in your country, it has to be a safe place for them to live. Brazil's got a lot going for it, but half the Intel Capital people that have worked there in the last 10 years have been mugged at knife or gunpoint. So, that sort of thing needs to be addressed.
Not good for venture.
No, not good for venture. Neither is a lot of pollution, which obviously is a problem in Asia at the moment. People are trying to move. They're wanting to move out of Beijing and other cities as well if they've got children. Corruption is an issue as well. If you open a unit there, you're going to trust that it's not going to get screwed over by corruption. So there are some sort of broader things, I say, harder to fix, but also important to encourage companies to come and locate in your country. So in terms of, I've got one more slide. Yeah, just another thing, because we're talking about the future and sort of trends, things that are happening. One of the things we're seeing is a little bit more of companies and organizations setting environmental or social impact goals as part of their investment strategy. And I've listed there 3 examples of funds that have been created that make the world a better place. And Professor Fung, is he Professor Fung here? Is Walter here? Where is he? He was here earlier. He was telling me at lunchtime that he's doing a seminar on orange technology, which is... That
actually belongs to my department in the Hong Kong PolyU. That would be very interesting.
Yeah. This is orange technology, which I had not heard of, I have to confess, but it's to do with happiness, creating happiness. So perhaps that's another thing where corporates can look at...
basically follow sort of the green set of technologies, but actually adding a measurement for human happiness as a key for the technology. That's sort of the idea behind orange technology.
Interesting thing to try and measure, but yeah.
Service medical is like bad, right? It's like a shot.
Since I'm going to be the keynote speaker there, I better know what I'm doing. So I need ideas.
I'll be interested to know what comes out of that seminar. So in terms of things that are going to happen, who knows? But I think we'll see more corporates collaborating with each other. I mentioned the multi-corporate funds, but in France, for example, Eco-Mobility Ventures is a collaboration between a train company, originally it was a car company, an energy company, and a telecoms provider, which is a fund to invest in sustainable transport. So those things are sort of increasing. I think this accelerator is a bit of a bubble potentially. There may be too many accelerators out there, and perhaps there needs to be a bit of rationalization of those. Corporate venturing, corporates tend to leap into ventures. There's been waves over the years, and they tend to leap in towards the end of a cycle. So we may be, seeing the top of a wave coming. I'm not sure. And then emerging markets are doing a lot more. They've recognized the need for innovation, and so I think the likes of Brazil that I mentioned before, and Singapore, and Hong Kong, and others. I think that we'll see the continued rise of those, and it'll be a challenge to. I think it'll be a challenge to Silicon Valley because if I was a young person, would I want to live in Santa Clara, or would I rather live in San Francisco, or Berlin, or London, or Hong Kong, or Shanghai? I don't know. You tell me. All of those, yeah. I've met a few people here who have actually lived in probably all of those. So. I'll hand over. We've got a conference in California then in January. It'd be lovely to see you there. We'll have about 350 people. So thank you very much.
My name is Jeff Chi. I'm the current chairman of the Singapore Venture Capital and Private Equity Association. We are an association of about 150 members, of which more than half, I would say, are investing members, what we call full corporate members. The membership currently accounts for, we estimate, about 60% of assets under management out of Singapore. And the association was founded 23 years ago. Interestingly enough, the earlier session talked a little bit about role in government. The association, the founding member of the association was actually the Economic Development Board of Singapore. So it was a lot of foresight in saying, let's get an ecosystem started, let's put together an association and get this thing off the ground. My day job, I'm a venture capitalist. I'm a managing director of Vickers Venture Partners. We're a partnership of 5 people. We're a Pan-Asian fund, about 200 million, just shy of 200 million of committed capital. We've invested about 160 of that over the last 10 years. We started 10 years ago. We're celebrating our 10th anniversary this year. And current valuation, we estimate about 900 million, so out of that. So that just gives you an overview. If there's anyone interested in finding out more, I'm happy to spend some time offline. So the topic today is really about the future of venture. So I wanted to talk a little bit about 2 things. One, I think, is a regional shift, and I think earlier we saw some slides demonstrating that. And the other is some new venture models that we have already seen coming onto the scene. So in terms of a regional shift, I think the first thing is the last 10 years or so we've seen this big move in terms of venture investing. I wouldn't say out of US and out of Europe, but we've seen Asia increasing in size. When I first started in this business 10 years ago and looking at investing in China was, I even remember writing the slides. So China was like the 5th or 6th largest venture market globally. Today it is without doubt the number 2 in terms of size, and number 3 is actually quite far away. So China's dominance has in Asia has created quite a bit of activity in the region. India, a little behind, not too far behind. But the more recent years, especially the last 3 or 4 years, we've seen a big emergence in Southeast Asia. And so I think that is one of the things I wanted to talk about. So 10 years ago, it was about the BRIC nations, Brazil, Russia, India, China. A lot of the LPs are now asking what's after the BRIC. One of the slides you saw earlier showed that the payouts from Asian VC funds, in particular the Chinese and the Indian funds, because that has formed the bulk of it, have not been all that attractive. So LPs are now looking towards new markets, what's next in their thinking, and we in Southeast Asia have seen increased attention. So we're getting fund of funds, endowments, beginning to set up presence, sending people to scout the area, looking for general partner relations that they can build. So really, in terms of venture, we see Southeast Asia coming of age, right? It is, the statistics are there. Most of you know them already. 600 million people, a growing middle class, decent GDP growth. All those make Southeast Asia a very attractive target for investing in venture. So these are some of the numbers. We've seen Southeast Asia venture quadruple in the last 4 to 5 years. So 4 or 5 years ago, if you ask me how large is venture in Southeast Asia, it was running about $250 million. The last 2 years, we've crossed $1 billion. The numbers you see in 2014 are a little, actually, some records show that 2014 was larger than 2015. It was the timing of the transaction and all that. So it depends on who you ask. And really, wearing my association hat, Singapore has been at the core of all this, right? So you see 46% of Southeast Asian transactions basically involving either Singapore funding or Singapore-related companies. So they have, so 46% is Singapore into Singapore companies. These are not just Singapore markets. These are because of the regulatory and infrastructure benefits that Singapore companies have. Even the Southeast Asian deals, some of the Indonesian deals that you see are structured as Singapore companies. Indonesia, in terms of venture investments, is a distant second at about 20%. Then you have Malaysia, Thailand, Vietnam, in the teens or so. So that gives you a flavor of the size of Southeast Asian venture. You can cut the data a few ways. You can look at the amount of money, where money's flowing from. One of the interesting things that Singapore has is that despite accounting for 60% of venture investments into the region, actually Singapore-based managers contribute only to around 16% of that. And the reason is because over the last few years, Singapore has with the building of the NRF and some of the schemes that you heard about earlier, build a network of global investors, right? So the investors that are in Singapore are now able to bring co-investors from outside Singapore to look at investments in the region. So one of the estimates that you've seen circulating around is that Southeast Asia is probably about 10 years behind where China was in terms of venture. My personal estimates is a little further behind. I think in terms of number of deals and value invested, it is about 10 years behind. But if you start looking at infrastructure and if you start looking at potential, what China had 10 years ago was a steady stream of exits and a pipeline of IPOs on the way. So 2005 would be the year where Baidu was already in the pipeline, where you had Focus Media already in the pipeline, where you had Shanda was already public. So you had a whole string of companies and proven, right? That hasn't happened in Southeast Asia yet. I think the largest recent deal was probably the trade sale of Viki to Rakuten, which was a $200 million deal. You've seen some landmark investments made recently, but and with the amount of investments going in, it's only a matter of time when you start seeing the exits. And when that happens, I think you will see Southeast Asia on an exponential growth. So for those of you thinking about the region, I think it is an opportune time to think about it. When you come in after the exponential growth, I think the boat's already left, and it will be sort of playing catch up. So this is the right time to be thinking about the market, to start making investments, not so much in deals, but in partnerships, and being able to building the capability of evaluating some of these deals. So the second part is really about some of the new venture trends that we see coming on in the region, right? So I think the first one, because this panel with the title was targeted at limited partners, is I think the investment mode that we see from limited partners is beginning to change, and whether it's driven by cheaper fees or lower fees, or whether it's driven by the ability to cherry pick deals to be able to boost higher returns, the trend is there that more and more LPs are asking for co-investment rights, and more LPs are looking to build their own investment teams and to do that. So across the different type of LPs that we see, fund of funds, not so much endowments, but even sovereign wealth funds, we're beginning to see that they are beginning to build their own capabilities to do that. The reality, though, I think, is that the model, something seems to be wrong with that model. And I'm not so much talking as a GP saying that the LPs are trying to stinge on the fees, but I think the ability for the LPs to react, right? So when I, as a GP, am thinking about putting a syndicated deal together that involves my LP, it is often easier going out to other commercial funds than waiting for a response from the LP. Because as they're building out their capabilities, many of them don't really have the capabilities. Many of them are really have one or two people overlooking the relationships with all the funds and all the investment opportunities from there. They have the expertise as financial investors to invest, but often are very unsure about the space that we invest in. So that tends to be a barrier, I think, and create some friction in having that model sort of play out. The other trend that we see, I think, that I have on the slide is this accelerators, and I think Tim spoke a little bit about maybe there are too many accelerators out there, but fact is that there are a lot of accelerators out there. Personally, the funding model of the accelerator is expensive for the ultimate investor, because a fund generally is more economic. Charging 2% a management fee a year is a lower cost than the operational cost of an accelerator. But that being said, the whole premise of the accelerator and the presence now of angels and this new class of what we call super angels are now in a way changing early round funding into startup companies, right? And when I say changing, it's changing in a very big way. Because when $1 million was enough for a Series A investment, today it's 5, and it's basically all the bars have been raised. So the seed round is the new Series A, and deals have become very, very expensive, and so we're seeing an inflation of valuation, and across geographies, you're seeing that trend happening right now. So Series A investments are becoming very, very expensive. There's another trend, and this I see most prominently in China, where I spend more than half my time. And China created a new board for listing. We talked a little bit about stock markets in the previous discussions, and this new board called the NNEQ, or directly translated, the new third board in China, is basically an OTC market that allows companies to list and trade very early on. And so we're beginning to see that post Super Angel round, where they raise $300,000-400,000, they go direct to listing, and you know, the success stories you hear that a year later they're a unicorn, right? I remember speaking with Neil Shen at Sequoia one day, and he was telling about his experience in discussing unicorns of China, and you know, because of the valuations of the Chinese stock market, you know, unicorns are actually quite common in China if they list on the Chinese stock exchange. A good example is Youku Tudou that listed on Nasdaq versus Leshi that's listed on the domestic markets. The valuation is manyfold different when the business of Leshi was actually a lot smaller than their Nasdaq counterparts. But that, I think, is another trend as well. So question, not definite, is the Series A investors relevant anymore, and do we have a space in this market? The last point I think talk a little bit about, and we can discuss in further detail in the panel, is crowdfunding, right? And crowdfunding is another model that has come into play. Now, crowdfunding for equity has been problematic. There's been recent press in the U.S. about the Jobs Act and how it's not perfect and how it's not protecting the retail investor and so on. And different regulations are dealing with that problem in different ways. But if you look into other areas of crowdfunding for rewards, you begin to see that actually there is a case for crowdfunding in this market, particularly for the hardware-based startups. So you now have a startup company that has a product idea that is able to crowdfund their prototypes and get their initial customers at the same time, right? And positioning the company for a much larger Series A round. I think the last thing, and I didn't have this on the bullet point, was I think Marta was the one who mentioned AngelList. And AngelList, I think, is another relevant point in the sense that if a notable investor, not necessarily a VC fund, is able to put a syndicate together because of his known track record in investing, that again is another potential model that could pose a threat to the traditional venture fund that charges a 2% fee and a 20% carry. So I think that's all I have. There's the contact detail for the association if you want to find out a little bit more and all that. And back to you.
Thank you very much. Okay. Thank you both very much for sharing. It's completely depressed me. Just think about this. The international investors, you can hear me, right?
I think the video.
Yeah.
Oh, they want? Okay.
You have a microphone?
Hi.
Yes.
How are you? Good. All right. The international investor that we're referring to here, your fund of funds and your endowments, in the alternative space, they'll put today 5-10% of total in venture. Out of that, they'll put 3% outside the United States and Europe. So start scaling your numbers down. And what tickets are you looking to write? 5 million, 3 million, 10 million, 20 if you're a lucky day? How many of them are there? Not that many. So, you know, we're just kind of chasing, you know, money that's not going to move the needle whatsoever. And the core difference here is domestic capital and government policy, because there needs to be scaling to be able to completely change the dynamic of the game. And that is what's important. And interestingly enough, some of the success from China comes from the fact that a lot of them bridged the West Coast and China. So when you go back 20 years, you find a lot of these very talented individuals, men and women, were all had two houses. One in China or in Hong Kong, and the other one was in California. But they all had houses in California. They were all part of that. And they spent 9 months of the year there, or whatever, 3 months here, right? And so that's because that's where they could find backing for their ideas. Because the infrastructure that the United States fell into, and they were fortunate because of a very strong academic support that they had, right? So when we look at this and we look at the alternatives that were presented, unless there's scaling There won't be a difference. And, we're just looking for kind of small ideas. And the problem is venture funds, seed funds, what, $100 million, $150 million? How many are you going to do, like 20,000 of them? What are we going to do with those, right? There has to be policy. There has to be a direction. But more importantly, academia and a government has to say, we want IT. We want our bright minds. We want young people to come and enjoy, and not necessarily make a profit, but to come up with phenomenal products that can benefit. Because all of us always show charts of the things that succeed. But how many companies out of 100 succeed? How many? Guys, how many? Jeff, how many?
Not that many.
No, that's the whole point, right? So, right? But in the meantime, what happens to the people that come up with these ideas, right? And so, when we get to the corporate venturing, there is a benefit to that because they are channeling talent in a particular way. They are identifying bright students, but that again goes back to the faculties having those bright students, which again goes back to government policy having those faculties having the structure to have those students, right? So I think we need to stop chasing the U.S. endowment to try to give you money in Singapore and get the Singaporean government and the Asian governments. We have capital market alliances. We have all these Asian pacts. Why don't we have a venture pact? Why don't you all come together? Why doesn't Singapore come together with other neighbors or other, equally minded countries and create a pool of talent and let them move around? Share some thoughts on that idea.
Yeah, so I think there are quite a few points in there, right?
Oh, many points.
Yeah. and I think the first 50. The first one I'd like to talk a little bit is I think you are spot on, right? So this is a market where there could be a lot of money chasing too few deals, yet at the same time, the reverse is also often true, which is the market, and that creates the market cyclicality. We are at a point in time, and because we are seeing early success in very huge up rounds coming from a few small companies, and people saying, hey, they raised $100 million. There's a market there. Let's put more money in. When the funds are getting more money, they say, but where's the deal now, right? So and then so the business in a way needs to be developed concurrently. It's an ecosystem where the deal flow and the managers of the funds and the ultimate investors of the fund grow it in concert. And I think in many markets we don't see that historically. Even with China, there was a time when a lot of money flowed in, and then there was no money at all. And then
so you keep talking about money, but isn't it really about innovation? I mean, isn't it, where is the Karolinska Institute in Asia? That's in Sweden, that's in Stockholm. The cutting edge, more Nobel Prize winners in health and science. Where? Show me.
What about
and why haven't you created it?
There's a collaboration between Tel Aviv University and Tsinghua called the Zin Research Center. I mean, I think there are things going on.
No, I know, but I'm just saying we need more of that, right? The Mayo Research Center.
There are quite a few things happening in terms of innovation and IP generation and all that. So about 2-3 years ago, Huawei overtook all their U.S. counterparts as the largest filer of patents. So you are beginning to see innovation coming out of Asia, coming out of China in particular. In many ways, that innovation is very much later stage. Governments in Asia have, relatively speaking, very little funding versus the U.S. European counterparts into basic research.
Yeah, but let me stop you here. Let me stop you. Why would the government not put a policy of all its life plan sponsors, so long life insurance companies, and the next panel can be shorter, the life insurance companies and pension plans, and say, put 5% in alternatives. Within the alternatives, we'd like to have X in venture, work with the academics, work with policy. Now, all of a sudden, we've got proper funding, right? Because one of the things that you haven't touched on, any of you, because I like corporate funding. I don't have an issue with corporate funding, but chasing a fund-to-fund out of the United States or Europe, what are you talking about, right? But the amount of volume of capital that's raising here, we'll get to questions in a moment, that are being raised. The volume of capital is being raised from local institutions is very high. And with proper regulations, proper structures, that can be channeled correctly. And then with the proper academic and centers of excellence, right, that then can incubate and create. And then we have this wonderful chart that you showed of angels and entrepreneurs. And the thing I hate the most is crowdfunding and listed. I think that's the worst thing you could ever do, because it either overprices something or makes something too expensive, right? So what are help me here in setting a stage, and then in today's world, what can we do in the short term?
I think there's, to the first point you were making, I think about, there's plenty of money for small rounds in an early stage. The issue still is the follow-on rounds, and that's why companies are failing, or they're moving to California, because there is the deeper pockets, more appetite for risk. So I met a startup here which was at Cyberport, and they just couldn't get the next round of funding, and they've pretty much died. So,
but were they a great idea?
Well, that's I don't know. Possibly not. That's another thing. Yeah.
That's an interesting point, though. You wanted to touch on accelerators, because both of you kind of felt that there was too much. What was the point you wanted to make on the accelerators?
It was just a question, really. One is, corporates. Are they the right people to run accelerators? Is it, if you've got a corporate person, rather than, say, specialist, serial entrepreneurs who are running accelerator that are then partnering with a corporate, which I think is probably
that's a great idea.
Slightly better model,
yeah.
And does exist.
Yeah.
But there are a lot of models out there, and I'd be interested in the audience's experience of accelerators as well, and what they think has been working, where they think it fits.
But for me right now, the reality is what you both presented, and that's what the world has to live with. And so the question then is, how can you change that? And the way to change that is to get access to capital. And this is where Europe has failed. Europe has failed. There hasn't been enough support and an infrastructure created when they could have. And so there isn't that kind of scalability. And again, as a result of that, you have movement. Because these young people need to get married, eat food, live somewhere, right? And so they're always drawn where the opportunity is, where capital is. And when you look at the charts we're showing with the demographies of Asia, and you're looking at the fact that it's more consumer-led, right? So all of a sudden, app and other IT type technologies become more prevalent. That should attract a lot of people. So then the question is, can you live here for inexpensively? And can you get the visas to be able to come here? In Berlin, you can, but they might close Schengen down. So we'll see about that one.
So to that point, I think the bottleneck, if you may, in terms of what I see in the Asian economies, at least, is not so much a lack of capital. It's not so much a threat. It is a lack of talent.
Right.
And I think because there's not enough money flowing into basic research, there's not enough money flowing into the development of talent. As these companies mature and they need to draw in more and more talent, half of my companies hire people from Europe, from Latin America, from the U.S. because they just can't find the talent domestically. I think China's a different story, but the Southeast Asian businesses that we invest in have in particular have that challenge. And with regards to money flowing into research, I think that's a longer term thing. That doesn't change overnight, and that needs to change in time. The shorter term issue is really the talent, and really because you mentioned that is it is it the consumer that's going to shape the market, or is it the science that's going to shape the market? And at least at Vickers, our current view is that at least in the next 5 years, it is the consumer that's going to shape the market, and that's where all the market opportunities are.
You know, one of the most interesting models I've seen is actually a European listed company, Oliver Schwarman, Rocket International, right? Or Rocket Capital, and that is a very interesting model because basically they roll all their profits in, they're able to grow, and they go to all the countries that are U.S. so to speak, and really have been able through that large pool of evergreen, as opposed to taking one individual company, listing it too early, and then It was really funny. I love fishing, and so I was my captain was this fantastic man in Florida, and we're not killing big fish. So I only fish what I consume, and so his father was an OTC stock trader, and he used to make markets in the old days when there weren't computers, and the way he used to make a fortune was he used to send a young kid to see if the company really existed. And there were a lot of companies that didn't exist. And so he would just short them and wait until all of a sudden somebody realized there wasn't anything there, and then he made a fortune. And so
that's harder to prove these days with
that's right.
virtual companies. Yeah.
Oh, that's right, yeah. Well, and this is part of the issue, right? And that's where, again, there's more duress on the regulators in this type of environment because abuse can take place, then putting in place policies of growth. Let's open for 5 minutes for a couple of questions, and then we'll call an end. Thank you, Nara. Yes, please. Let us know who you are, if you're a venture capitalist, an investor, or a mind.
Definitely not a mind. Probably private equity fund, Access Capital. My question relates to the new venture model that I find very interesting from Alibaba Pictures. Alibaba basically sold Yulebao to Alibaba Pictures. And if people know what that model entails, I won't go into the details. So my question is, given that, what do the panel think about the probability of success of the Yulebao model?
One sentence on the model. People know.
Oh, it's complicated. You need about 5 sentences. But I'll try to explain it anyway after I pose my question. Do you think that that model will succeed? And if it does, doesn't it make venture capital funds a dinosaur, which will get disintermediated by what is essentially, I think, a crowdfunding model? So I'll just, with 2 or 3 sentences for those people who are not familiar with the Yulebao model. Yulebao means entertainment treasure, and it was developed by Alibaba. And the whole world can go on and read movie scripts that are posted online, and they vote for the script that they would like to see most made into a movie, and they back up their voting with money. And you can pay $10 to see the script get made into a movie, $20. The more you like the script, the more you pay. And then the Yulebao then aggregates, using big data, the responses to see, oh, this script actually has a lot of crowd support. And then they calculate, betting what the returns to those individual investors are. But that's actually not the major source of the funding. They then take that data and they go to the real big money movie backers and say, hey, my pre-movie research shows that this movie will be well accepted. And then the real movie backers say, okay, then I'll put in $1 billion or $300 million, depending on whether you are producing for Avatar or not, into that movie. And then the crowd guys who actually put in money on that movie, they then don't get a substantial return on their puny amounts of money invested. What they do is that they get things that they really want, which is like VIP invitations to the first screening, backstage meetings with the stars, which really appeals to these people. So
yeah, but this exists in the States. Have you seen the movie Spectre? Mm-hmm. You sound like C. All right, it's a people business. I'm M. I really am M.
Well,
So-
can I be Bond then?
Yeah. And you can be Bond too. So, this is all fine, but it's not going anywhere. My son did that, and he had a very successful movie. But I mean, at the end of the day, this is an example of something that kind of appeals to a certain crowd. But what you just said it's these people aren't making any money, right? They just got a little bit of appeal. So you might as well give you a trophy, put it on your TV, and you can look at it every day and can say you're a great guy, I mean, this isn't what we need here today, and this isn't the point of this panel. The point of this panel is a people business, and it's a government responsibility. And the infrastructures, if somebody comes up with a creative way to kind of get some scripts turned into movies, fantastic. But listen, my friend, you got to shoot the movie, you got to get the actors and the actresses, you got to get the right timing, you got the right space, you got the right commercials, you got the right things. I can keep going for an hour here, right? So the ability to make money here, fine, you might get the odd success. But the truth of the matter is venture capital is a choice that individuals that have a lot of talent make, right?
I agree with that. But it has been a successful model for books, hasn't it? Because crowdsourcing has then led agents to recognize actually this book is popular. But it's very different reading a book to a script, because as you say, there's a lot more to making a film than the script. You can have a good script but a terrible film, and the other way around. So I'm not sure that it's going to.
I had a question for you. Do you read your books on an iPad or a Kindle, or do you read hard copy?
Both.
I read hard copy stuff.
Right.
I like that, yeah.
But I have done some screenwriting, and it to read a script and to be able to assess whether it's going to work well as a film is really quite a skill. So I don't think the general public are going to be able to predict very well what's going to be a successful film, but it'd be fun exercise.
That's fun. That's right. And another question, then I think we have to call it, please.
What's your thoughts on? It's Suraj, and I am from San Francisco. What's your thoughts on engineering reform? Within the universities, because the thing I see that the reason why Silicon Valley does very well. There's two things. Firstly, we have some great universities. Secondly, it's kind of easy to build a company from 0 to 100 million within the valley. The minute you take the company from 100 million onwards, and there's very few people. You need product managers at different levels. You need engineering managers at different levels. And the problem about Southeast Asia, it's still in its infancy, with the exception of Alibaba and a few other companies. There's very few people who understand how to build those companies.
That's what they were saying before.
Yeah.
But one thing is interesting, because you mentioned universities, and we talk about universities, but how many of the talent in venture and creation actually sometimes goes and finishes university, because they're too bright for university? So how do you capture these people, right? That's absolutely correct. Zuckerberg and Gates, yeah. So, but your point is correct, and I think the panel said this earlier. We need talent. Sorry? No, we need talent, though, right?
I think what you are referring to is applications, very simple technologies. When it comes to deep innovation, new materials, biochemistry, medicine, you cannot escape universities.
No, but I agree with that. No, but I'm saying some have, right?
So
I think so. Well, thank you very much. Thank you.
Thank you very much. We are now approaching, in a rapid pace, the last panel. And as you can see, Moose, you have to sit down. No, I don't take pictures. Okay, thank you. Very important. Very important. Very important.
Yeah, thank you.